A trade war doesn't usually change in a single morning. It typically unfolds over weeks or even months through official statements, retaliatory measures, tariff adjustments, and policy decisions that markets gradually learn to price in. But this time, that familiar rhythm was shattered. Instead of following the predictable cycle of escalation and response, the entire situation entered a completely different phase almost overnight. When Donald Trump escalated pressure on Canada, it wasn't simply another trade policy adjustment. It became a direct test of assumptions that global financial markets had relied on for years. In Washington's view, stability meant maintaining control over the outcome, believing that sustained economic pressure would eventually force Canada back into alignment. For a long time, that assumption appeared to hold, until Canada responded in a way that financial models simply hadn't anticipated. By the time investors and analysts realized something fundamental had changed, the first wave of that shift had already passed through the system. What followed began with what looked like nothing more than a routine escalation. The United States increased pressure, tightened its trade demands, and presented them as the final terms of ongoing negotiations. On the surface, it looked like the familiar playbook: apply enough pressure, force a reaction, and bring the other side back to the negotiating table on stronger terms. But markets don't react to intentions, they react to structure. And this time, the structure had changed in a way few expected. Canada didn't respond within the usual cycle. It didn't immediately mirror tariffs or launch a rapid political retaliation. Instead, under Mark Carney's leadership, Ottawa challenged the very assumption behind Washington's strategy that Canada would behave predictably, absorb the pressure, and eventually return to negotiations following the same familiar pattern. That was exactly the pattern markets had priced in. Tariffs would trigger counter-tariffs. Political pressure would lead to negotiations. Negotiations would drag on until both sides reached a compromise. For years, that cycle had defined Canada, U.S. trade disputes, and financial markets had built their expectations around it. But this time, Canada stepped outside that familiar cycle. At first, nothing seemed unusual. There was no dramatic announcement, no immediate countermeasure, and no visible escalation that suggested a breaking point had been reached. For a brief period, even experienced analysts assumed it was simply another familiar phase in a long-running trade dispute. Then the first signals began to emerge, not through political headlines, but through the behavior of financial markets. Bond markets started moving in ways that didn't align with broader economic data. Currency traders noticed coordinated shifts that couldn't be explained by any clear policy announcement. Equity markets began showing pressure across multiple sectors without a single defining news trigger. And that lack of explanation became the first warning sign. Because in financial markets, when movement comes before the story, it usually means the real story hasn't been fully uncovered yet. Behind the scenes, something much larger was already taking shape. What Wall Street didn't immediately realize was that what they were witnessing was only the first layer of something much larger. Canada's response wasn't designed to be a single, highly visible move. Instead, it was built to unfold gradually, step by step, across different parts of the financial system. From the outside, investors believed they were watching a standard escalation in a trade dispute, but in reality, they were already inside Canada's response without even realizing it. And that's exactly what made it so difficult to interpret in real time. Markets don't panic when something happens. They panic when they realize something has been happening for far longer than they thought. By the time traders recognized that Canada's actions weren't isolated reactions but part of a coordinated sequence, the second phase was already underway. Meanwhile, Washington continued to operate under a familiar assumption that sustained pressure would eventually produce a predictable response. The strategy never changed: impose more tariffs, tighten restrictions, escalate public messaging, and wait for the other side to adjust. That approach had worked in previous disputes, but this time, the expected response never came. Instead, the distortion within the financial system began to deepen. Credit spreads between American and Canadian institutions started widening in ways that couldn't be explained by economic fundamentals alone. Energy-linked derivatives began showing unusual hedging activity. Cross-border capital flows, which normally remained stable even during periods of political tension, started shifting through less direct channels. None of these movements were explained through official communication, making them even harder to interpret. And in financial markets, uncertainty grows fastest when the data moves ahead of the explanation. Behind the scenes, Canadian institutions were already moving into alignment, not through public announcements or political statements, but through internal positioning. Large pension funds, regulated capital pools, and state-linked financial institutions were quietly making coordinated adjustments. Individually, each move appeared minor, but together, they formed a pattern that was becoming increasingly difficult to ignore. At first, many on Wall Street dismissed it as noise, temporary repositioning driven by broader global uncertainty. They expected the pattern to fade once Washington clarified its next move. Instead, Washington escalated once again. But that escalation exposed a critical miscalculation, the assumption that Canada would continue responding within the same predictable framework. It didn't. Instead of matching pressure with visible retaliation, Canada's response was unfolding through financial structure, coordinated alignment, and strategic positioning rather than political confrontation. And that was the difference most early analysis failed to recognize, because what was unfolding was no longer a simple cycle of action and reaction. It was an entire system adjusting itself. The shift became unmistakable when the pattern stopped looking like isolated reactions and began resembling coordinated movement across the broader financial system. In fixed income markets, pressure was no longer confined to individual bonds. It began reshaping expectations across the entire yield curve. In equity markets, entire sectors started rotating in ways that would normally require a major macroeconomic catalyst. Yet no single headline could explain what investors were seeing. Instead of relying on official statements, currency traders began positioning themselves based on where they believed long-term capital flows were actually heading. And beneath it all was the same defining pattern: synchronized movement without a synchronized explanation. Inside Canada's financial system, what had been quietly developing was now operating in full alignment. It wasn't driven by one dramatic intervention or a single massive transaction. Instead, it was a distributed framework, multiple institutions making different adjustments, yet all moving in the same direction. That was the part most analysts missed in the early stages. They were still searching for individual actions. One major policy decision, one headline-making announcement, one clear act of retaliation. But what they were actually witnessing was something much broader, a transformation in the behavior of the system itself. And once a system changes the way it operates, it no longer responds like a collection of independent parts. It begins functioning as a single coordinated mechanism. Washington, however, continued viewing events through the old framework. The assumption remained that sustained pressure would eventually force Canada back into a familiar cycle of escalation, talks, compromise, and stabilization. But Canada wasn't returning to that familiar cycle. It was moving beyond it. And that distinction gradually began to appear in institutional analysis. Research teams across major financial firms started revising their models because the standard assumption that countries respond symmetrically under economic pressure no longer matched what the data was revealing. Rather than relying solely on political channels, Canada appeared to be operating through its financial architecture, adjusting exposure, timing, and capital flows in ways that didn't require highly visible policy announcements to be effective. Meanwhile, Washington continued escalating through the tools it understood best: tariffs, public statements, and economic pressure. But the system it was trying to influence was no longer responding on the same level. And that's where the gap between expectation and reality began to widen, because markets don't wait for certainty. They reprice the moment expectations begin to change. What was unfolding was never a series of disconnected reactions. It was the activation of a system that had already been prepared in advance. As that realization spread through major financial institutions on Wall Street, the entire conflict began to look less like a series of political decisions and more like a carefully structured process that had been unfolding long before the latest escalation. From that perspective, Washington's latest move no longer appeared to be the central event. Instead, it became the trigger that exposed a framework already in motion beneath the surface. By this stage, the line between politics and finance had become increasingly blurred. Every political statement from Washington was quickly reflected in market positioning, while every shift in the markets reshaped how the political situation itself was being interpreted. The two systems were no longer operating independently. They were feeding into one another in real time. Yet Washington continued speaking in familiar terms. The assumption remained that sustained pressure would eventually bring Canada back into the traditional cycle of negotiations, concessions, and compromises would restore balance. But by then, the financial system had already moved beyond that assumption. Markets were no longer reacting to individual announcements. They were responding to a deeper framework, one that appeared to have been designed to function regardless of political messaging. And that's when the interpretation began to change. Analysts were no longer asking what Canada would do next. They were asking something far more fundamental. Had the framework already been in place long before Washington's latest escalation even began? If that was true, then nothing unfolding in real time was improvised. It was simply the gradual emergence of a process that had already been set in motion. And by the time that possibility was fully understood, the nature of the entire conflict had changed. It was no longer about who could apply pressure more aggressively. It was about who had positioned themselves before the pressure even began. And once that question emerged, it changed everything that followed.